Hi, everybody. Michael Haas back for episode 3 of the Debits and Credits with Haas and Dawe podcast series. In the first two episodes, we talked about some history. We talked about the escrow industry in California, and now we're going to go a little bit elastic on that. And while we're talking about escrow still to a certain extent, we're going to get more into what the type of entities are and some tax information. And there are different types of business entities from a tax standpoint that people can choose, and how does it impact what they do, how they do, why they do within their operating their companies. Now, the four major entities. Well, let's just dive it down a little bit further. There are two major entities that are business entities relative to running a business. One of them is a corporation, and one of them is a partnership. Now, with a corporation, you have shareholders, and with a partnership, you have partners and or members. Now, within the corporations, there are two types of corporations. There can be a C corporation or an S corporation. Those are tax concepts. Corporations themselves are legal entities. With partnership, again, you have legal entities. There can be a general partnership, but something else that has developed over the last 20 years is something called a limited liability company. Now, a lot of people think that's a tax concept. That's not. That's a legal concept. It's how to limit somebody's liability within the ownership of the entity that they have. And for the most part in today's world, there are very few general partnerships that are not limited liability companies, or LLCs, as they're familiarly known. But they're taxed as a partnership, meaning that the partners pay the tax of what goes on. With corporations, C corporation pays its own tax, and an S corporation, tax on the income is paid by the shareholders of the corporation. It's also known as a pass-through entity because the income is passing through to the shareholder. One other thing that can throw a wrench into this, and we'll talk a little bit more about this in a little bit, is an LLC by default is taxed as a partnership. But if it wants to, it can choose to be taxed as a corporation, and would have a reason for do that relative to what it does operationally. So these are the major entities. Now, in going back to our escrow world, or to the escrow industry, the independent escrow companies in California have to be corporations. That's in the financial code. So they have to be corporations. Same thing with title companies in California. They have to be corporations. And real estate brokerages have to be corporations relative to how their structure is set up. Now, then they can choose how they want to be taxed. So an escrow company can be taxed as a C corporation, which means that the corporation will pay its own tax and retain all its income. And an S corporation, all the income flows through to the individual shareholder or shareholders, and they pay the tax on their individual tax returns. How do you decide what to be? What do you want to be? It can be for a number of reasons. It can be for purely from a tax planning standpoint. It can be from an entity planning standpoint. How do you want to move forward? Because these entities, just like we as individuals have to pay tax every year, these entities have to report taxes once a year as well. And so, depending on when the company is organized, such as a corporation gets incorporated in California through the Secretary of State's office, it's going to have an incorporation date. It has to file a tax return no more or no later than 12 months later. An LLC, a partnership, same thing. Once it gets organized within California, again at the Secretary of State's office, it has to file a tax return or a return of some sort no later than 12 months later, so that at least once a year there's corporations, these corporations and entities are filing tax returns. Now, it could be that the company wants to have a specific year end. So let's say today is a day in January, and a company wants to have June as its year end for tax purposes. It can do that. It just has to file its first tax return based on a June year end, and then every year thereafter it will file its taxes every June. It could be that a corporation is organized in April and it wants to be December as its year end. So come December, it will file its first tax return, and then every December. But it may also be that a company forms in April, but it wants to go as long as possible, so it won't file a tax return until the following March. And then March becomes its year end once it files its first tax return. And companies can make the decision whenever they want it to be within their first filing. Now, they also can change the year end if they want to change it, but they have to file a request with the Internal Revenue Service to change the end of their tax year after they've already elected the first time. Now, here's another monkey in the wrench in the formula. An S corporation, by default, has to file as a calendar year, as a December 31 tax return. Now, there are a couple ways out of it, but by default, it's going to start as a calendar year, December 31 tax filing corporation. An LLC or a partnership also have to file as calendar year entities. That's in statute. Now, sometimes people don't want to do that because of where their income flow is. Because it may be that a company has a seasonality to it, as when they're busy, when they're not, and they're going to base when they want to file their tax return based on the seasonality, and want to have their year end be in a different month other than calendar. Another reason people want to get away from calendar is because they file as individuals with a calendar year. Individuals file a tax return based on every December, whether they're getting a W-2 from an employer, or they're a sole proprietor, or whether they're getting a pass-through of the income from the corporation. And so they'll want to say, well, I'd rather not pay tax on my corporation the same time I pay tax on my individual. So they'll want a year end that's not the same as December. And so this is how it gets involved with helping with tax and entity planning. And let's say someone has two corporations. They have an escrow company corporation, and they have another corporation that has nothing to do with escrow. And so they want to not have them both at the same time because of the different reasons for what their tax filings are. And it could be that their income stream is different. It could be that their seasonality is different. It could be that they just don't want to be bothered with having to deal with all that accounting work being done at one time at the end of the year, because they're too busy with everything else going on to have to try and get everything together for their accountant to do their taxes. Now, what are the tax implications of these entities? We talked about C corporations pay their own tax. Right now, it changed in 2018 when the tax law got passed back in 2018, that the corporation tax rate is at 21%. It's a flat tax rate. All corporations pay tax at 21% on their corporate income. And in California, it's 8.84% is what corporations who are C corporations pay to California for their income tax. Now, again, they can be any fiscal year they want. They can be a December, they can be a January, they can be a July, any month of the year they want to end. And then within 3.5 months of the due date the end of the filing year, such as, let's say, a December 31 C corporation has to pay its taxes by April 15th. So it's 3.5 months later when they have to file. With an S corporation, it's different. They only have 2.5 months to file their tax return. And so by March 15th, is when they have to file, because they want to give the shareholders a chance to file their income taxes on time. And so that's why the S corporations, you see, they're going to push to get their tax returns done faster, but they don't pay any tax to federal. They do pay some tax to California at a much lower rate of 1.5%, and they have a minimum tax of $800 in California. But otherwise, all the income goes through to the individuals. Now, the other thing about an S corporation that's a little bit of a nuance that we don't see very often anymore, but if an S corporation really does not want to file as a calendar year, as a December 31, they can choose to have a tax return on some other date, but they have to pay money to the federal government, meaning that they're going to estimate whatever their income is, and then they have to pay an estimated tax to the IRS on this income, because the IRS doesn't want people who doesn't want these S corporations, these shareholders, to be able to defer the tax beyond a calendar year basis. So it's just their way of trying to get their pound of flesh early, so to speak, an acceleration of tax payments to get their use of the money ahead of time. But I said, we've seen since the law changed, I'm going to date myself here, 1983 is when the law changed for S corporations having to be calendar year. We've seen two clients have fiscal year S corporation taxes. So it's not very common. And then there's the LLC. The LLC is a limited liability company. And so what we have is a situation that they can, what's their entity type? So they want to be a partnership. If they're going to be a partnership, they have more than one member of this LLC. And so they're going to calculate the tax, and then each partner, each member of the LLC, depending on its percentage of ownership, will pay tax on its own individual return. Now, the LLC can elect to be taxed as a corporation, and if it elects to do that with the IRS, then it's going to be filing a corporation tax return and will follow the laws and the rules that we talked about a few minutes ago. Now, what's also interesting about this LLC, because keep in mind, it's a legal concept, that it can be a single member LLC. Partnership, there cannot be a single member partnership because you can't have one partner of a partnership because the name itself implies you have more than one. And so if you're a general partnership, you're going to have more than one member or more than one partner. But if you're a single member LLC, you can do that. And what happens, that's called a disregarded entity because the LLC does not file any income tax return if it only has one member. The single member is the taxpayer. So if the single member is an individual, the tax is paid by the individual on the individual's tax return. If the single member is a corporation, then you're dealing with the corporate tax law, and the income is reported by the corporation. If the single member is a trust, then you're dealing with the trust filing the tax return, and that's a whole nother series of podcasts is talking about trusts, and so on. And so the only thing that a single member has to do as far as tax filing goes in California, with all the other states, it has to do a filing every year with the state it's organized in. So in California, it has to file every year with California. It has to pay a minimum of $800 to California. And if the gross receipts of the limited liability company, the single member LLC, is over a certain limit, then it's going to pay more. So it just, again, California gets its piece of flesh as well. But that's how an LLC is taxed. Single members are taxed by the single member. Other members multi-members are taxed as partnerships unless they want to be taxed as a corporation. And now partnerships, same thing. It flows through to the individual based on the percentage of ownership. And partnerships have certain rules in California to a certain extent that if you're a general partnership, you just have to file it's called a return of income, where you're disclosing to the IRS and to the Franchise Tax Board what the income the partnership had and how much is being passed through to the individual partners. So there is a full tax return filed by a partnership, reporting all income and expense and what the pass-through is due to the individuals. In California, you can also have a limited partnership. They're not very common anymore. They were more common in the 60s and 70s, but they were replaced by the LLCs. But a limited partnership also has to pay $800 to California, in addition to filing a tax return reporting income out to the partners. And so you have these different entities. And then we'll have future sessions on tax planning, on how to I'll say manipulate, but I don't mean that in a bad way, the corporate income and the partnership income and the LLC income, so that the lowest possible tax is being paid, but all the reporting is being done properly. And then how all of this impacts the companies on a financial statement basis, because a lot of the companies do file financial statements. Now, we talked to the escrow companies, they get audited, so they have audited financial statements. But for some of these companies, they may just have to file financial statements with their banks or with their lenders or with bonding companies. So they all have a need for it. So you'll see how we can coordinate the taxes and the financial statements with the structure of the entity. And that'll be coming forward in a future podcast. That's all for now. Michael Haas signing off, and we'll catch up with you with the next episode.